Warren Buffett is well known for his insightful perspectives on investing, one of which is his famous quote, "Diversification is protection against ignorance." At first glance, this statement may seem counterintuitive, especially since diversification is often promoted as a key strategy for managing risk. However, Buffett suggests that spreading investments too broadly can actually be a sign of not fully understanding the businesses in which one invests. Rather than reducing risk, excessive diversification might dilute potential returns and mask a lack of deep knowledge. This approach challenges conventional wisdom and invites investors to reconsider the true purpose and potential pitfalls of diversification. The quote possesses an undeniably seductive quality, drawing in aspiring investors with promises of success and exclusivity. Its language is carefully crafted to appeal to the ego, suggesting that those who heed its advice are destined for greatness. This flattery can be intoxicating, making individuals feel uniquely capable or insightful. By tapping into the desire for recognition and achievement, the quote encourages a sense of belonging to an elite group. Such a lure can motivate action, but it also risks clouding judgment, as investors may become more focused on validation than on sound decision-making. Ultimately, the quote's charm lies in its ability to make listeners feel empowered and special, fueling their ambition to succeed. At the heart of this discussion lies a crucial idea. The quote, while seemingly empowering, can actually serve as an intellectual trap for investors. By encouraging a sense of overconfidence, it may prompt individuals to disregard prudent analysis and take on unnecessary risks. This mindset can blur the line between calculated decision-making and reckless speculation. As a result, investors might find themselves exposed to significant losses, all while believing they are simply following sound advice. Recognizing this potential pitfall is essential for maintaining a balanced and thoughtful approach to investing. The concept of closing loops offers a fresh perspective on understanding Warren Buffett's statement. By examining how information is processed and acted upon, we can identify gaps that often lead to misinterpretation. Closing these loops means ensuring that each part of a message is fully understood before moving forward. This approach helps to clarify intent and context, reducing the likelihood of confusion. As we unravel the layers of misunderstanding, we begin to see how deliberate communication can bridge the divide between what is said and what is heard. Ultimately, closing loops fosters a more accurate and meaningful exchange of ideas. Many ambitious investors and financial influencers often misinterpret the quote, viewing it as a direct endorsement of aggressive risk-taking or relentless pursuit of wealth. This widespread misunderstanding can lead to the promotion of strategies that prioritize quick gains over thoughtful decision-making. Social media platforms amplify these interpretations, with influencers frequently using the quote to justify speculative investments. As a result, the original intent behind the words is overshadowed by a narrative that encourages bold moves without sufficient caution. This trend highlights the importance of context when applying philosophical ideas to financial decisions. By examining the true meaning of the quote, investors can avoid falling into the trap of impulsive actions driven by popular sentiment. The quote is often interpreted as a direct challenge or even an insult to investors, suggesting that their current approach may be lacking in focus or conviction. This perception can provoke a strong reaction, motivating investors to reevaluate their strategies. In response, many choose to concentrate their portfolios, reducing the number of holdings and focusing on their highest conviction ideas. This shift is driven by a desire to prove their expertise and decisiveness. By narrowing their investments, they aim to demonstrate a deeper understanding and commitment to their chosen assets. Ultimately, the quote serves as a catalyst for more purposeful and concentrated investing. Ego can dramatically alter the way we approach investing. Instead of focusing on careful risk management and thoughtful decision-making, Ego often pushes individuals to seek validation through bold, risky moves. This shift turns investing into a high-stakes gamble where the desire to prove oneself outweighs prudent analysis. As a result, investors may ignore warning signs, overestimate their abilities, and chase unrealistic returns. The line between calculated risk and reckless speculation becomes blurred. Ultimately, ego-driven investing can lead to significant losses and undermine long-term financial goals. The myth has gained significant traction across social media platforms, where influencers and self-proclaimed experts frequently promote it as common wisdom. Viral posts and trending videos often reinforce these misconceptions, making them appear more credible to a wide audience. Popular investment advice channels and forums tend to echo these ideas, further amplifying their reach. As a result, many individuals encounter the myth repeatedly, sometimes without questioning its validity. This widespread exposure can shape public perception and influence financial decisions, even among those with limited investment experience. The persistence of the myth in digital spaces underscores the importance of critical thinking when evaluating financial advice. Imagine a novice who misunderstands the guidance of an expert, believing they have mastered a complex skill after hearing only a few tips. This kind of misinterpretation can lead to risky decisions and unintended consequences. Similarly, myths often arise when information is taken out of context or oversimplified, causing people to act on incomplete or incorrect knowledge. The danger lies not just in the initial misunderstanding, but in the confidence it instills, which may encourage hazardous behavior. Recognizing the gap between expert advice and novice interpretation is crucial to avoiding these pitfalls. By seeking clarity and deeper understanding, individuals can make safer, more informed choices. The myth suggests that taking bold risks is a hallmark of intelligence and sophistication, subtly persuading investors to embrace uncertainty. This narrative often leads individuals to believe that calculated risk-taking is synonymous with financial acumen, even when the risks are not fully understood or justified. As a result, investors may overlook warning signs and underestimate potential losses, assuming that their actions are backed by superior knowledge. The allure of being seen as savvy or ahead of the curve can cloud judgment, encouraging decisions that are more reckless than wise. Ultimately, this myth can foster a culture where risk is glamorized and caution is dismissed, leaving investors vulnerable to significant setbacks. When Warren Buffett refers to ignorance, he is not speaking about a lack of intelligence or ability. Instead, he uses the term to describe situations where investors do not fully understand the businesses or markets in which they are involved. Buffett emphasizes that acknowledging one's own limitations is crucial in making sound investment decisions. By recognizing and respecting areas of ignorance, investors can avoid unnecessary risks and focus on opportunities within their circle of competence. This technical definition underscores the importance of humility and self-awareness in successful investing, rather than overconfidence or speculation. For Warren Buffett, truly knowing what you're doing goes far beyond surface-level understanding. It means conducting a thorough analysis of a business, delving into its financial statements, competitive advantages, and long-term prospects. Buffett emphasizes the importance of grasping not just the numbers, but also the underlying drivers that make a company successful. Equally vital is psychological fortitude, the ability to remain rational and disciplined, especially when market sentiment turns volatile. This combination of deep business insight and emotional resilience allows Buffett to make confident decisions and avoid common pitfalls that ensnare less prepared investors. Warren Buffett is renowned for his highly concentrated investment approach, often allocating significant portions of his portfolio to just a few select companies. He believes that deep understanding and conviction in a business are essential before making such large commitments. This strategy requires not only extensive research, but also a temperament that can withstand market volatility and uncertainty. Most investors, however, lack the time, expertise, or emotional discipline to replicate Buffett's level of concentration. Diversification remains a safer choice for the majority, helping to mitigate risk and reduce the impact of individual stock fluctuations. Buffett's standards are a reflection of his unique skill set and experience, making them difficult, if not impossible, for most people to emulate successfully. Warren Buffett has consistently emphasized that diversification is the rational approach for most investors. According to his own logic, spreading investments across a range of assets helps to minimize risk and protect against unforeseen market fluctuations. While Buffett himself may concentrate his holdings due to his deep expertise and access to information, he acknowledges that the average investor does not possess such advantages. Diversification, therefore, acts as a safeguard, ensuring that no single setback can significantly impact an entire portfolio. This principle remains one of the most reliable strategies for building long-term financial security. Many investors fall into the trap of thinking that diversification is unnecessary, especially when a single asset or sector appears to be performing well. However, this belief is a form of ignorance that can expose portfolios to significant risk. Markets are unpredictable, and relying too heavily on one investment can lead to substantial losses if conditions change. Diversification helps to spread risk across different assets, industries, or regions, making it a fundamental principle of sound investing. Ignoring this strategy can leave even the most confident investors vulnerable to unforeseen downturns. Ultimately, true wisdom in investing lies in recognizing the importance of a well-balanced portfolio. The quote is considered dangerous because it can be used to oversimplify complex market realities, leading investors to make decisions based on misleading assumptions. When repeated without context, it often encourages overconfidence or complacency, making individuals more vulnerable to market volatility. Some market participants weaponize the quote by using it to justify risky strategies or to persuade others to ignore warning signs. This can result in investors holding on to losing positions for too long or entering trades without proper risk assessment. Ultimately, the misuse of the quote can amplify financial losses and erode trust in sound investment principles. One common trap in decision-making is confusing conviction with competence. Just because someone feels strongly about an idea does not necessarily mean they possess the skills or knowledge required to execute it effectively. Similarly, it's easy to mistake intense feelings or enthusiasm for genuine expertise. This confusion can lead to overconfidence and poor judgment, as emotional certainty is often mistaken for factual understanding. Recognizing this distinction is crucial, as relying solely on feelings can obscure the need for actual experience and informed analysis. By separating emotional conviction from proven competence, we can make more balanced and effective choices. Warren Buffett's conviction in his investment choices is the result of decades spent analyzing businesses, studying market cycles, and refining his approach. His decisions are grounded in deep research and a thorough understanding of the companies he invests in. In contrast, many investors today operate with a more superficial sense of conviction, often relying on trends, headlines, or fleeting market sentiment. This difference in approach can lead to vastly different outcomes, especially during periods of market volatility. Buffett's steadfastness is rooted in evidence and experience, while others may find their confidence quickly shaken when conditions change. Ultimately, true conviction in investing requires patience, discipline, and a commitment to continuous learning. This quote provides a subtle form of intellectual permission, allowing individuals to justify gambling under the guise of clever strategy. By framing risky bets as acts of brilliance, It encourages people to overlook the inherent dangers and unpredictability of chance. The language used can make reckless decisions appear calculated and inspired rather than impulsive. As a result, individuals may feel emboldened to take greater risks, believing they possess unique insight or skill. This rationalization can blur the line between genuine expertise and mere luck, leading to potentially harmful behavior disguised as wisdom. True protection against ignorance begins with embracing humility. By acknowledging that no one possesses all the answers, we open ourselves to learning and growth. Accepting our own limitations allows us to seek knowledge from others and to question our assumptions. This mindset fosters curiosity and resilience rather than defensiveness or denial. In recognizing what we do not know, we create space for understanding and wisdom to flourish. Humility, therefore, is not a weakness, but a powerful shield against the dangers of ignorance. Humility plays a crucial role in successful investing, especially when it comes to building a diversified portfolio. By acknowledging that no one can predict market movements with absolute certainty, investors are more likely to spread their investments across different asset classes. This approach helps reduce risk and protects against unexpected downturns in any single sector. As a result, diversification fosters a sense of safety and stability, allowing investors to feel more secure about their financial future. The peace of mind that comes from knowing your investments are balanced can ease anxiety and encourage long-term thinking. Ultimately, embracing humility in investment decisions leads to a smoother, less stressful journey toward financial goals. In closing, it is essential to recognize the value of self-awareness when making financial decisions. Understanding your own goals, risk tolerance, and habits can help you navigate the complexities of investing. Prudence and thoughtful consideration should guide every step, ensuring that choices align with your long-term objectives. By knowing yourself and staying informed, you can build a foundation for wise investments and lasting financial well-being. Remember, the most successful investors are those who combine knowledge with self-reflection and careful planning.